Can you hear me at the back? All good? Yeah, thank you so much. Congratulations, first of all, and best wishes to the PMS Bazaar team for the 7th summit. I am privileged to be part of all the 7 summits, and thank you, Pallav, and the entire team for inviting me again. In the 7th summit, we have an interesting topic that is the core of the investment management business. That is decoding the sources of alpha across market cycles. Yeah? And just before coming here, I just checked that when you were in the 6th summit, the markets were about 63,000, 64,000. And today, as we stand, maybe it's down 79,000, but the Sensex has given a return about 25%, and mid and small cap roughly about 35%. Yeah. And also, before coming here, I was just talking to a few people here. According to them, what are the sources of alpha? Yeah. So they've given some pointers to me, and I tried to Google the sources of alpha, and it throwed some 8 to 10 points. So let's try and ask the experts here, according to them, what are those their answers on the sources of alpha. So let me begin. Maybe let me begin with Anirudh there. Anirudh, there has been always a debate for decades between the active management and buy and hold style of management. So does active create alpha or buy and hold create alpha? Your thoughts and how are you managing it at your end?
Yeah, hi Nimesh. So I think with regard to this active versus passive, I think that's a debate which has been always there. And in fact, there's a lot of factual data which shows that 80% of the active funds have underperformed the index. So that is something which, again, I would say brings investors to the point that doesn't make sense to be in an active fund. But one thing which I would say all the more for Indian markets is that, yes, actively managed funds do outperform the index. Having said that, I think what has really worked for us is a blend of both active and passive. The main driving factor behind that has to be your earnings and the valuations. So it's not that you would want to have a very active portfolio just for the sake of buying and selling. Idea is that do the valuations of your portfolio companies get support from the earnings growth? If valuations move way ahead compared to earnings, whether you're buying it for the short term or the long term, I think it makes sense to book profits and exit. At the same time, if you have companies which earnings are doing exceptionally well, valuations look expensive, but they continue to outperform the market with regard to earnings, I think there's no harm in holding it for the long run. If I look at my own portfolio, practically 70% will be buy and hold. Around 30% would be kind of, wherein active is there. But that buy and hold is also something which I would see every quarter, every 6 months, whether valuations have moved way ahead of the earnings growth. So I think, to put it in one line, a blend of both active and buy and hold is what works in the Indian markets, keeping an eye on the earnings and the valuations.
Fantastic. And for the benefit of all, I think about 9 years, Anirudh has been able to deliver about 7% alpha, 9+ years. So that's fantastic.
7.5, yeah.
Sorry?
Around 7.5%.
7.5% alpha. So fantastic. And a blend of both. Maybe let's bring Amit, who had a stellar record in the last 5 years. I think 10+% alpha, 12, 13%. What's your thought? Does the active create or a buy and hold create alpha?
So ideally, is it? Yeah. So ideally, our portfolio is the best 25 entrepreneurs at any given point of time. And we want to be passive. But I look at my portfolio like a cricket team. If I have 25 players in my cricket team and some of the players get injured, some business model change, some regulation change, just bad execution, we move out because we have 25 players in the dressing room also, always waiting to enter the portfolio. So we are emotionless. If we want to be, if you keep growing extremely fast, you keep delivering, you will have, basically the entrepreneurs need to work hard to be part of our portfolio. It's not the other way around. I don't find entrepreneurs. The entrepreneurs, if they keep performing well, we will automatically find and buy them. We don't, basically it's the other way around. We don't look at entrepreneurs. The entrepreneurs' execution make us basically make our strategy. But yes, active or passive, there's no thing as passive in this world. Even the index is not passive. So it's like how active should be the question, that how active should you be? And activity will be based on execution. If if you are with the best 25 executors, you will be super passive, and these executors remain the top best executors, you're passive. If these executors screw up, you become active. So active, this is how I look at it.
Yeah, so again, blend of both. Let me now bring in the other two panelists here and ask my second question. Maybe Madan, to you. Does value style of investment create alpha or growth style create alpha? Your thoughts, please.
That's very interesting, given that last 2 years we have seen value doing extremely well. We have 2 layers of experience, and we see it depends on what tenor you look at. Value generally creates a very sharp alpha in a very short period. And in the long term, I think growth really plays a major role in creating a sustainable alpha. If you look at last 12 years of our journey, a lot of this alpha was created by growth stocks in the initial first years by companies like Eicher Motors, Page Industries, which delivered phenomenal growth compared to the other consumption stocks. In the second half, if you see companies like Trend, Titan have delivered phenomenal growth and they're part of our portfolio. So I feel that it depends on the tenor that you're looking at. In the long term, if you want to create sustainable alpha, a few of these stocks, and as Amit said, it is all about the entrepreneurs, right? Some of these guys have kept on increasing the TAM of the business they do, and they keep on delivering a higher growth. And I wouldn't have imagined that Trent will be making into Nifty in a 5-year time period since the time we invested. It created some 20,000 crore to 2,40,000 crore market cap company. I mean, Asian Paints took almost like 20 years to do this. Trent did this in 6 years. So we are in a zone like some of these growth stocks is going to surprise you in terms of what they can deliver in terms of alpha. But it's very important that you have a healthy mix of both. And also how you mix this depends on the market cycle. So that's something which we are very conscious about. So it's about bucketing. And how do you bucket depending upon market cycle is something which can create you an extra alpha over it.
Great. So again, combination of both what you're saying, value and growth on a longer period create alpha. Rahul, your thoughts on the same, please?
So between value and growth, right? Usually the blend will always work well. As Madan sir rightly mentioned that depending on the market cycle, you have to position your portfolio in such a way. If it's a growth cycle, you'll have to have kind of a larger blend of growth stocks in the portfolio. And since we were discussing Nifty stocks, right? We've seen even Zomato, right? Even the measure of trend within less 4 years, it's going to be a part of Nifty by March. So given the market dynamics, right? A continuous blend, and you have to consistently keep evaluating the market cycles and where your portfolio positioning is going to be. A blend will always be better off.
Great, thanks. That brings us to the third question, which a lot of people, I just took a poll, and let me ask that question. Maybe I bring you Anirudh again. So does investing in market cap create alpha? Buying in small cap, mid cap, because in the last 1 year, as between the 6th and 7th summit, small mid caps have done 35% and large caps have done about 25%. So what creates alpha? Is the market cap?
I think, this whole debate again around which is good, the large, mid, small, that is something which is always on. And the last 6 months is something which we have been hearing a lot around the noise around small caps being expensive. You should move from the small caps into the large caps and all. I would say that you have expensive small caps, expensive mid caps, expensive even the large caps. You have attractive small caps, attractive mid caps, attractive the large caps. So idea is it has to be completely dependent on the company which we are looking, irrespective of the market cap. If I see my own last 8-10 years, I would say some of my biggest winners have been the large caps. And some of the biggest winners have also been the small caps and the mid caps. So I think it's more important to find out where the biggest earnings growth is happening, where the market is not giving the right valuation, and that is irrespective of the market cap is where I would say the allocations have to be. Just to give an example, in the last 6 months with all the debate around sell small caps, move to large caps, I actually did the reverse. I decreased my large cap allocations, increased my small cap allocations for a very simple reason. With panic on the ground, people were dumping good companies at any price. I had those companies on my investor, I would say, list. When you get something 25-30% below what you were getting a couple of months back, I think that's a time you move out of something which has not fallen. In fact, the large caps which I held, they had not declined much. The small caps which I wanted to buy, they fell 25, 30%. Entered into them in the month of April, May. From April to now, on an average, they are up around 80%. So it's
How much?
around 80%.
Wow.
So it shows that you have to be there with your list ready, irrespective of the market cap at which you are going to buy.
You're up 80% from this March, this April.
Those companies. Those companies.
Your portfolio is up how much?
Around 30%.
I'll be tracking your portfolio only every day.
Everybody was wanted to ask,
gave me a
what is your
biggest FOMO,
portfolio?
yeah.
Please share your portfolio.
No, I think, see, it's a blend. Ultimately, if everything is up 80%, your portfolio returns would have been very different. But idea was to say that you have to be ready with the names irrespective of the market caps. And if you get panic on the, like that's what we hear, when there's panic, you buy. But you have to do your work earlier and then keep those names ready.
So another thing which he brought out is the bottoms-up investing is at the core and not the top-down of selecting. That's what comes out from your Amit's answer, all the answers there. Let's bring in Rahul. What have you been investing, small, large, mid, and what's your thought on creating alpha through?
See, in FY24, right, if you see the total profitability pool, there was almost like 14 lakh crores for NSE 500 companies. Now, even if you go in further dissection, in Q1, again, 3.5 lakh crores of profitability across NSE 500. Now, within that, if you remove the banking sector, which is close to giving the profitability of 1.4 lakh crores. So 40% of profitability is still coming from the banks. X of banks, you have to find the profitability pool and which kind of companies are going to continue to grow the profitability of the overall pool. So we continuously keep evaluating across the market caps, a blend of large caps and small caps. There'll always be pockets where valuations and mispricing of assets will be there. A blend always will work better. The idea is to keep focusing on the valuations. And for example, as he rightly said, that the reallocation of assets. Even we had some of the defense names in the past 6 months where we moved out. And we shifted a little bit to the lower beta names. In fact, our small cap portfolio in the past 6 months has given positive returns, even in this market volatility.
Commendable work. Let's bring to the next question. Madan has a long track record. And if I'm right, Madan, 12 years, the CSOP has been there, about 5 to 6% alpha. So what have you done? You do like concentrated portfolios to create alpha or more diversified kind of portfolios for creating alpha?
Concentrated any day, because I think investing into those specific 5-6 stocks where you create a meaningful alpha and then add upon it certain large stocks. So you asked about large caps versus mid cap versus small cap. We approach this in this way. When we go to large cap, we don't go with searching for growth companies. There are 4 or 5 stocks in Nifty where growth is impressive, but you really don't get more than 10% growth in majority of the Nifty stocks. You go and search there for value. Is there anything missed out in this stock and this company has been investing, which can play out in the next 1 to 2 year time period? But when you go searching for big alpha, I think it has always come from mid caps. Particularly 4-5 years back, 20 to 30,000 crore market companies, if they had grown very well, I think they have created a meaningful alpha. And that's where our majority of allocation has always been, and concentration of the portfolio has always been. We always had some large caps, but the major part of the allocation was in this space. Small caps added icing on the cake. If you get 4 or 5 ideas in small cap, right? And there, it is not about companies which can grow for a long period. It's about companies which can, which are in a niche space and they can do well in a short period of time and create you good returns. So this is how we look at, and always concentration has been the best way to, in our opinion, because diversification last 2 years again, given the flow that has happened in the market, passives have done well. So diversified portfolios would have done well. But going forward, when the flows are going to be balanced, if not moderating, and the earnings is also going to be moderate. It's not going to be as good as it was in the last 2 years. If you're going to approach the market in a diversified, passive way, then you will be up for some surprise in the way you can generate return, because there will always be the tail which is going to drag you, which is what happened in 18, 19, 20. In those periods, I think concentrated portfolios did extremely well in terms of creating alpha over diversified portfolios. I think we are getting into that zone in the next 2-3 years is what we feel. So basically, if you're doing diversified passives, you need flows. You also need certain macro tailwinds. They don't keep coming every year, once in 10 years, 2 times in 10 years. But you want to sustain a longer period, you have to have concentrated bets on certain growth stocks and certain specific value stocks is what we feel.
Interesting. Anybody wants to add points, one can do that. But again, a blend of both, there is no what's such rule. You want to add, Anil?
So I think, again, this whole debate around diversification versus concentration, there has been, in fact, a lot of the international, I would say the research work which has been done on that, what is the ideal number of stocks one should have? Because, you have the, I would say the plus and the minus of both. Diversification has its, the plus and the minus, same for, I would say, if you have a very considered portfolio. Ideally, what has really worked well is anything between 15 to 30 names. So 15 to 30 names is what is, I would say, a well-diversified and a well-concentrated portfolio, in which what it should be is basically what I adopted in a portfolio. The top 10 names make up practically 50 to 55% of the portfolio, which shows your high conviction bets. Among the top 10, the top 4 names will make up roughly around 30% of your portfolio, which means wherever the conviction is high, you have a higher allocation. And as the conviction is low, you gradually want to build it up over time. So top 10 making up 55, top 20 making up almost 85% of the portfolio is broadly what approach I take.
Interesting. So when I was talking outside to a few people, one of the things common was there, timing is most critical for creating alpha. So let me bring in Amit, you're smiling. Please answer your thoughts. Is timing critical in creating alpha? Would you hold cash in your portfolio? What are your thoughts in the current market levels? Over to you.
So Nimishji, my way of looking at things is that there are only 4 decisions that we fund managers make. What to buy, when to buy, how much to buy, and when to sell. There are only 4 decisions that we make. What to buy, when to buy, how much to buy, and when to sell. And the entire industry manages 3.5, 4 lakh crores, whatever the industry manages. Whatever commissions that we made is basically is because of the decisions we make. And when to buy is a massively important decision. There have to be frameworks when you're doing when to buy. You cannot buy any stock at any price and expect to create massive amounts of alphas. If your goal is alpha creation, if you're beta, then it's okay. But if your goal is alpha creation, you need to know when to buy. You can do it with an earning beat. You can do it with when there is some large private equity exit. You can do it before demergers. There are just patterns on when to buy. People do it on breakouts also. When entire sectors making new highs, there are multiple patterns where you can create, but timing is important. You can so we don't time the market per se, but the stocks that we have in our portfolio, we do sometimes time the stocks that this is when I want to get in and this is when I want to get out. When there is a large MSCI buying, typically those are very good exits for us, and we get massive liquidity and very good exits typically. And if you see the stocks which enter MSCI, like Trent, we had sold very large positions at 7,800 because it got into Nifty. But we bought it again at 7,000 also, but that's a different topic before the numbers, but we sold. So you do end up making decent size. See, depends on what you want. If you want to do 2% alpha, 3% alpha, then you should not waste your timing in timing the market. If you want to do 20% alpha, 15% alphas, it will not come just by security selection. Depends on life goals. If your life's goals are large, then you have to get it right on all 4 parameters. That what to buy, when to buy, how much to buy, and when to sell. If your goals are just like 2% alpha, then what to buy will suffice your alpha targets, or 3% alpha. So this is how I look at it.
Very different perspective. Anybody else wants to just add what they've been doing? Are they holding cash at the current levels? Because that's what the investor, that's what the partners would like to know. Anything, Madan? Yeah?
No, I think cash is never a right way to. I think India is not dried out so much that you need to hold cash at any point of time. But temporarily, you can hold cash to look for next best opportunity. India keeps on throwing opportunities. I think even today, if you look at the kind of interest that is there in the small cap and mid cap space in terms of manufacturing space, a lot of new ideas keep flowing from there. Lot of deals keep happening in B side also, right? So a lot of that is also throwing opportunities on the listed space also what can happen. I don't think cash as an, temporarily you can maintain slightly higher cash if you're waiting for some opportunities to come. But otherwise, I think in the long term, taking sharp cash calls has ever helped, particularly given the return that India has delivered. I think cash is never a right way to.
Agree. the greatest investor, Warren Buffett, also says in his book, cash is a source of risk. So agree with both. And I think Amit, what he does is uniquely not time the market, but time the sectors and the stocks which he's trying.
And also, cash is not a position, it's an outcome of you not getting stock ideas. Like today, we are on 14% cash. But I swear I get sleepless nights because I am on 14% cash. Because I'm not able to find opportunities to deploy money. Entrepreneurs are not growing fast enough to get my money. But we are working hard and hopefully will be deployed fully.
Great, thanks. Rahul, let me bring you in. Is alpha generation then in your research or approach or ability to identify the themes earlier, and what kind of approach you follow at Nippon, please?
So at Nippon, right, we have a very formal process, five-step process that we have to follow in terms of for small caps, it's like the total addressable market, which is very critical. If we follow the process, not just themes, but even idea generation, alpha generation, the overall process will lead to a very high alpha generation in the medium term. Now, identifying the themes earlier is never going to be easy. A lot of these names are getting discounted at pre-IPO or VC or PE level, right? So in terms of, again, you have to go back to you have got the theme, but eventually you'll have to get back to the formal structure where in terms of your valuation, earning growth profile, the quality of the management remains a critical factors there. So I believe that in terms of catching the theme earlier, yes, we are able to do in some of the names. But overall, we believe that the alpha generation will happen only and only with valuations, which is going to catch up in the long term.
Interesting. Anil, we all have some quest approach. So can you share a bit about that? And then maybe Madan about the long philosophy and process you have, please.
See, with regard to the research, because I think, investment is like, you can't have different parts of the team working independently. It all works in sync. One thing which I've been a very strong believer for a long time, and that I think really works, is if you have to beat the market, you have to be different from the market. You can't have the same stocks which everyone else is buying, because ultimately all of us in this room, we end up, so suppose the equity market is over here. If all of us buy the same stocks, you can't outperform anyone. So I think that is where the portfolio differentiation really makes a difference. And so one thing which I've mandated my team is that don't look for the herd companies, look for companies which others are not approaching at this point of time. In fact, most of the companies in our portfolio, I would say it would have entered our portfolio and many of the broking houses would have done the research after that. So that really makes a difference, that you're able to identify the themes, companies, much before than what the market has identified, because that is a big component of alpha creation in the long run. If everything becomes good in a company and then you enter, definitely the valuations are not on your side. So that is where the extra work happens. And that is where we spend a lot of time analyzing companies which are not there in our portfolio, companies which we might have had in the past and we have exited. We continue interacting with those companies to understand those inflection points when, again, we want to enter. So I think a continuous approach of research, going beyond what is there evident, is what really makes a big difference in the portfolio returns.
What do you, Madan, you have longest track record in terms of Sundaram.
So I think predominantly, as I said, we focus a lot on growth orientation. What I generally put to my research team is, what are the next 100 stocks outside Nifty which has potential to get into Nifty in the next 5-6 years time period? And majority of the time of my research is spent on that segment. So much so, many of the Nifty stocks, we try to get the ideas from the sell side as much as possible. Internal research is mostly focused on which are the sectors which can make into the Nifty in the next 5-6 years or 10 years time period. That approach has helped us to get into something like a Trend, Bajaj Finance. Chola has not made it, but I think Chola is a guy who can make into Nifty in next 4-5 year time period. Zomato made into BSE. So that approach is where majority of the research time is spent, and most of the other sectors like staples or pharma, generic pharma, oil and gas, we generally outsource this or mostly use the sell side. So this is the philosophy we follow, and I think that has given us good results, because some of these mid caps which are staying outside today are something which is going to replace some of the IT stocks and pharma stocks and oil and gas stocks in Nifty in next 10 years, in our opinion. If you participate in that journey, what happens is, after a point, a lot of passives will chase them. today, I think 10 lakh crore of money is passive. So if you are into a mid cap which is going to go through this journey in the next 5 years, 6 years, your re-rating also happens along with the earnings. So you get 20-25% earnings growth, some 10-15% re-rating alpha also gets created. That is our learning from all those mid cap names which have worked well for us. So that is where the focus of the research and the process is.
Amit, let me bring you in with adding a part here that along with the process philosophy, how important is risk management?
For us, risk management is everything. I'll give you an example, Nimeshji. Our total pre-fees returns is around 38% CAGR for last 6 years and post-fees around 34%. My portfolio beta against Nifty 500 is 0.86. My portfolio beta against Nifty 50 is 0.8. My portfolio standard deviation is 20% lower than Nifty 50. My total returns, pre-fees, because when you're doing attribution analysis, pre-fees is the right way of looking. It will be around 600-700% in 6 years. We have only one fund, and this is our return, 600-700% in 6 years. But if you see my top 11 winners, we have made 223%. Our top 11 winners, we have made 223% returns. Our top 11 losers, we have lost only 9%. Only 9%. Fundamentally, we ride our winners and we cut our losers. So as I said, I'm not emotional at the start of it. And we are not even a small cap fund. If you take our 70 months average, we are 72 months old, but 70-month average, we are 52% large cap. We are about 8% cash, 26% mid cap, 14% small cap. And anything less than 40,000 crores is small cap now, 40,000 crores. So on every parameter, you look at beta, standard deviation, large, mid, small, risk management on attribution. If you do not get risk management right, I've been a trader before I've been an investor. And in trading, there is only one rule, that you have to manage your risk. There is, returns come automatically. If you're smart enough, returns come automatically. So while for us, risk management is everything. We do not hold on to our losers. We have every kind of risk management system. We might not be among the best performing funds, that's okay. But like we are, but for risk management, we will not hopefully screw up ever. So game के अंदर तो हमेशा ही रहेंगे.
Interesting. As time is running out, maybe I'll ask the last question and let me bring directly to referring to our topic today. And since the India-Australia tests are going on, let me put a cricket question here. You know, the batsmen love the flat kind of wickets and a smaller grounds. And bowlers love the Perth kind of a wicket with lush green field. What kind of conditions does an equity manager like? The bull markets, the bear markets, which cycle create more alpha? And I can leave the floor, since the last question is there, anybody can answer. You want to start from that side? Amit?
Actually, I made my largest alphas between 2009 to 2014 in percentage terms, because market returns were 0% in that time. But you had stocks like Page Industries, Whirlpool, and these kind of stocks which used to grow 40%. You ideally want 3-4% Nifty EPS growth. आप सोचो 2014 से लेकर 2000 Sun Pharma, Ajanta Pharma, every quarter would grow at 60%. No problem. These are the kind of opportunities you want. Ideally what you want, that the companies that I am invested in grow at 50%. Companies which everyone else is invested grow at 0%. तो पूरा पैसा तो हमारे कंपनी में ही आएगा ना. पैसा तो घूमता रहता है, right? So ideally you want recession, but your companies need to grow at 50%. And that is where you end up making, I get very happy if I'm example long company ABC and my company is growing at 40%. And if company B in that same sector, I'm not taking names, but if company B in that sector grows at 10%, मैं कभी-कभी तो weight भी बढ़ा देता हूँ कि in this sector, it becomes sure that boss, that you cannot beat this guy. This guy is something else. Like in underwear, it used to happen. The first player को beat करने वाला second, third, fourth would say that boss, first to 10, so there's only one player. उसके बाद हम लोग 12, 13, 14 आते हैं. You cannot, there are in many sectors, like Trent, example, because everyone spoke Trent. Trend used to grow. This quarter was 39% growth, but every quarter would come at 50% growth. And Shopper Stop would do minus 4% growth. मेरे को बहुत खुशी होती थी. मेरे को लगता था यार ये best है. And you know, ideally, biggest alphas are created when economy is slow, but the companies that you are invested in are rocking. And like this year, my alphas would be 50% net of tax, net of fees, sorry. So why this happened? Because my companies are the only companies which are growing in the market. Last year, my alpha was 40%. Even if it was a value year, we did very well. Net of fees, I'm speaking. This happened because of other companies not performing as well as my companies performing. So in a bear,
Great.
I don't know if it was a bull market or a bear
Amit
market.
thrives in a bear kind of a market. Any other thoughts? Madan, what do you think? Which market cycles create more alpha? And for you?
Like as Amit said also, like best of the alpha for any concentrated focused fund manager happens in when the wickets are like Perth. Not like the second innings, like the first innings it happened in the recent test match. So we also love that phase where you can show your ability to stand out in terms of alpha creation. But I think what we have also understood is like bull markets can be used to your advantage. And you can play and have a, as I said, a bucketing approach wherein some part of those value which does well in that period also can be accommodated to create a good alpha creation. At the end of the day, one thing we are there for is to create returns to the investors. So I think bucketing is much better. So either of the pitch, it's about the batsman, how he accommodates it. But we always like lush green pitches.
Great. Rahul, for you?
So my view is like investors, right, at this point of time need to think from the contra side of it. If there are recessions, if there are, negativity around the macros and everything that is getting built out, either in the economy or around the stocks or around the sectors, these are the times, so-called bear markets, where you need to accumulate more. So when the bull run comes, you make that decent alpha generation and wealth creation happens. So start from the bear markets, end up in the bull markets. That's the way to start and invest your money.
Right. Closing comments, Anirudh, from your side?
See, I think you as an investor, in absolute terms, you'll make more returns in the market, which is kind of doing exceptionally well, wherein everything under the sun is going up. But when it comes to alpha creation, I think that is where in a market which we are now, alpha creation happens in this type of market, wherein everything is not doing equally well. Having said that, I would say that I'll just give an example. Like I was just having a word with him outside. 6 months back, any meeting I used to go to, investors used to give me ideas. So now when I go for meetings, they ask for ideas. So that shows a big difference that now everything is not doing well. So I would say alpha creation happens in a weak market. Absolute gains are made more in the good markets.
So fantastic. And so I think most of you are agreeing that between the 7th and 8th summit now, it's going to be the bottoms-up approach which will create alpha. So just like to close this panel as we're just running out of time. As you heard from the experts, there is no one way or method to create alpha. It takes a lot of time, effort, and experience to generate continuous alpha across market cycles. So my personal submission or request to the audience, the IFA partners, the advisor, would be to choose a professional manager from this panel or all the other speakers coming today. And I assure you that each of the portfolio manager has a very strong, robust investment process, risk management parameters. And if you spend enough time with them, all of them will create alpha over a longer period of time. It's about your selection and your choice with among the managers. So with that, I would like to just close this panel here. Thank you all panelists for the wonderful conversation. And thank you audience for the patient listening.